Okay, we're going to start today with the S&P 500. You can see from this Yahoo Finance chart that we are right at the 100-day moving average, which is green. And we this week we had a very interesting week. We started the week right where we left it off at the end of the week. So we had a huge drop on Monday, and we totally recovered. The drop on Monday was due to some overseas volatility. And so that we'll go over a little bit about what to do whenever there's volatility in the stock market. But basically, a lot of times whenever there's huge volatility, the best thing to do is to do nothing, because a lot of times the stock market comes back within a short amount of time after it drops. But you can see we're oversold. We're at 28 on the stochastics, which is pretty low, and we're going up. So, and people were fearful in the stock market. You can see that we're hugging the 100-day moving average, which is the green line. The next line of defense or line of support for the stock market is the 200-day moving average. That's at 501. We're currently at 530. So let's look at our calendar. Our calendar shows that we've gone through some important earnings reports this past week. We have a CPI report coming out on Wednesday. And we have a little change where in our CPI and government reports, we're trying to root for a strong economy. And a strong economy means that we're not going into a recession. And there's a big fear on Monday that we might go into a recession. And a lot of times, if we have a recession, that means the stock market goes down like 15%. And we don't want that. We want like an in-between where it's not a recession and we have lower interest rates without inflation. That's the ultimate Goldilocks. We've had that for several years now, since the pandemic. Now, and we expect there to be an interest rate cut when the Fed meets at their meeting on September. That's 1 month away. So we have that to look forward to. September has always been a bad month, so we don't expect too much out of the stock market. We expect it to go down. We're after this week, 90% of the stocks have reported. We have one more earnings report, big one, NVIDIA, on at the end of this month. So we're watching out for that. All right, hold on. All right, so let's look at some of our talking points. S&P, even though we went down 10% in the intraday on Monday, we ended up the week unchanged in the S&P, which is pretty amazing. We're still lacking momentum in the stock market. We have fear appearing in the stock market. We had a very fearful market this week. We're still oversold, and the U.S. Treasuries are down or up. I'm sorry, they're up 4% this week. So they started the week at 3.7 for the 10-year, and it's went to 3.94. All right, so now we have a little switch. We are actually rooting for the 10-year to go up, because that kind of proves that the economy is okay. Now, we still don't have a whole lot of momentum in the stock market. The number of stocks above the 50-day moving average is still relatively low. So we're losing momentum. We are seeing a reversion to the mean, which we were predicting since the beginning of the year. Healthcare, telecom, financials, energy, utilities, the ones that did bad last year are starting to do better now because that kind of these sectors promote stability. And when there's volatility in the stock market and the stock market is going down and there could be a recession, these are the most popular stocks. So we had a geopolitical event this week. I'll explain a little bit about that later on. You see, look at some of our market returns from the last 40 years. August has been like a flat month. September has been one of the worst months. Then at the end of the year, we usually have a rally. So we're ready for that if it ever happens. Okay. You can see in the S&P, we're still kind of in a decent range. We're oversold and in the stochastics, and we're near the bottom of our channel line. So in that, it seems like it's a good time to buy in the near term. All right. And we did have some good earnings reports this week, which could help the stocks. Now, we mentioned 2 weeks ago, we had, at least for the past year or more, we've had an inverse correlation between the U.S. Treasury yield and the S&P 500 stock market chart. 2 weeks ago, that changed from an inversion to directly correlated. So as the U.S. Treasury goes up, the stock market goes up with it because the U.S. Treasury is kind of a indicator of how good the economy is right now. And whenever it goes up, right now the stock market is going up. So there is a direct correlation. Same thing with the U.S. 2-year Treasury. So this two-year Treasury yield is very important because it's basically a yield that the Fed targets whenever it sets its interest rates. So this is a very important number there. Let's look at some of our major variables in the stock market. Price of oil hasn't changed a whole lot. Inflation isn't changing. The dollar is unchanged since last week, and gold is unchanged. So a lot of our variables are not changing that much. When price of oil goes down, it usually indicates the economies around the world are not doing that great, and there's a slowing in the economies. Whenever we see this go up to $90 a barrel, that means the economy is doing really good around the world. Let's look at the dollar index is basically flat. It's not changing recently. Fear and greed index. We've moved to extreme fear from fear. We've had a huge scare this week where the stock market went down on Monday. So usually around the times that there's extreme fear, it's the time not to sell and the time to start looking for things to buy if you have money to spend. Okay, so we are expecting extreme fear all year long for these 2 months, August and September. So don't be surprised if we see extreme fear in the next 2 months here. All right, so the AAII sentiment survey, we have a reduction in bullishness and an increase in bearishness. So they're almost equal now. They have been bullish for at least a year, and now they're starting to turn bullish. So that's a contrary indicator. So if the amateur investors out there are bearish, that is an indication that it's time to start looking to buy things. Okay, so the VIX, you can see this is one of the highest readings in the VIX since the pandemic. So we did have a huge scare in the stock market this week. We are super fortunate that that didn't turn out to be a catastrophe. The VIX spiked up to 40 this week. That is pretty amazing. And we're back down basically to where we were at the beginning of the week. So that kind of shows that the market is kind of resilient and there's a lot of buyers that buy dips. But right now we're still at 20. We're still kind of complacent. 20 is like in between fearful and complacency. So I think but we did have that huge spike of investor fearfulness. In our emotional graph, you can see that we didn't go the whole way down to capitulation on Monday morning, but we had some major stocks like Apple going down 10%, and we had Nvidia down a lot. We had it's very close to capitulation. So we did have these feelings. Whenever you have capitulation, you can't sell your things. You have to understand this is only temporary, and you have to realize that whatever is happening globally, geopolitical events, any kind of events, does it affect your stock? If it doesn't, then you have to realize it's not the time to sell. Um, okay, so there was a little bit of fear that the US economy was going into a recession. We had something called a carry trade, which means that there were some hedge funds and large money managers that were borrowing money in Japan bonds, and because they had lower interest rates, and whenever they raised the interest rates in for the Japan economy, the Fed in the Japan, that caused a lot of selling in a lot of risk assets like Bitcoin and stocks and the Magnificent Seven. So that basically unraveled and it's back to normal now. So we don't have to worry about that. Um, let's see. All right, so there's a little Twitter note from FactSet. The forward PE multiple of the S&P is 20. That is right near the 5-year average of 19.4. So we are about the average, according to FactSet. The PE of the S&P is about the average that we've been in the past 5 years, but we've been pretty elevated for 5 years. The 10-year average is 17.9. So, we're maybe 10% off of the 10-year average of the S&P. So that means we might correct 10% to return to a mean and average for the S&P price to earnings ratio. Okay, we've been reviewing this since beginning of the year. The worst to first. The first to worst. These are the sectors that we're doing. I mean, this is how good and bad the sectors did last year. You can see IT did the best, communication services did next best, utilities did the worst. So now you can see utilities are starting to outperform, and they are one of the highest sectors. Consumer staples are actually doing well too. They're up 11%. Financials, um, they are actually doing better this year, 12%. And IT and communication services, they've been going down like 10% in the past month or two. Now they're still up 18, 19%. So this just goes to show you, if you're an investor and you see IT going up like 48% a year, you're going to want to pile into that because the natural tendency for an investor is to go with what's doing good. But you have to also realize that trees don't grow to the sky. They basically, the performance rotates through sectors. And we are actually seeing now that some of this is the example of worst to first. The consumer discretionary from last year went up 40%. Now it's a negative 1.3%. So from the beginning of the year, we've been tracking the winners of last year will be losers of this year, and losers of last year will be winners of this year. So that's turning out to be, for the most part, almost true. We'll see what happens the rest of the year. Weight loss drugs affects all industries. Yes. So we do see this week we had Eli Lilly and Novo Nordisk report earnings, and Novo Nordisk didn't have that great of an earnings, but Eli Lilly blasted through their earnings. Um, so our themes for the year are still doing pretty good, and we'll keep an eye on that. And let me see. So our worst sector this year is consumer discretionary. The materials sector is the next worst. Real estate, probably because of the interest rates not being reduced until recently. And communication services and IT, they're both basically the same sector. They're up 20%. All right, let's look at some of the market movers for today. We have let me see. Expedia, Eli Lilly, Palo Alto, that this is competitor to CrowdStrike. So we had CrowdStrike going down quite a bit, 40%. They're the number one antivirus cybersecurity company. And they're still getting bad news every day. So Palo Alto is actually one of the biggest competitors. So maybe that's bad news for CrowdStrike is good news for Palo Alto. We have NRG Energy. We have our theme of um, utilities, energy for the AI data centers. That's part of the NRG Energy. Maybe that's why that's up this week. We have Eli Lilly had great earnings on Thursday, so they've been going up ever since. And we have Expedia had good earnings too. What stocks are going down the most? Intel. Intel is they had a really bad earnings report, and they are behind the curve in AI also. So this is one we've been saying for over a year now that it's kind of dicey because it's hard to turn around a company that's um, not cutting edge anymore and is losing business. So that's a good thing we're staying away from that one. Um, Let me see what other ones there are in this top. Okay. Oh, look at that one, Aptiv. We'll have to review this someday. Aptiv is stock that actually showed up on our screener for this week. I ran a screen for for stocks, and you can see Google, MasterCard, T-Mobile. These are stocks that we've been following for a long time. On the bottom of this, you'll see Aptiv. They have a PEG ratio of 0.2 and like 20 is in the growth. So they're growing around 25+% a year. And at the PEG ratio of 0.2, they're out of favor right now because EVs, um, EVs are out of favor. There's a lot of bad stories around EVs because of maybe the new administration coming in might not be so nice to the EV companies. And there's a lot of competition. So Aptiv, um, they sell the inner workings for electronics for a lot of the EV vehicles. So we'll look at that next week because I didn't prepare something this week, but seeing that they're going down, it'd be nice to look at that. They're a smaller company. Let's look at the what other ones are going down. Wynn, Las Vegas Sands. Okay, a lot of companies. These are companies that took on a lot of debt whenever there was the pandemic because no one could visit the casinos, and that's what these have in common. Um, Okay, Dexcom. They are a competitor of Eli Lilly. They do a lot of work with um what is it? Dialysis. They do a lot of work with um mm, I'm not well, they're competing with Eli Lilly. Eli Lilly just came out with a lot of really good earnings. So maybe because of that, they might be taking some of their market share. Um, let's see. Let's look at that. Look to see if Dexcom is in this. No, DaVita is one of the ones that showed up on our screen. Another um another one a related stock. Okay, so let's look at the ones going up and down in the Nasdaq. We've seen Monster Beverage, um, Costco, Broadcom, Meta, Zscaler. Okay, so we have a theme of cybersecurity stocks going up. The competitors to CrowdStrike, which is taking a hit, 40% hit this week. Zscaler and Palo Alto are both competitors. We'll review some of those cybersecurities another week because that's a really important sector that the companies, businesses have to buy that. It's they might have like a 20% growth in that sector in general. So that's a very interesting sector for me. But right now, let's keep our eyes on Meta, which is up a lot this year. They're still doing good from some of the ad spending for the presidential election. Let's look at the ones doing the worst. We see that you see a lot of chip companies in the top decliners. We have Global Foundries, they do chip manufacturing. We have NXP Semiconductors, Microchip, ASML Holdings, all chip companies, Intel, of course. So that's a good thing. I'm not invested in any of those. So let's look at some of our talking points for our okay, let's go back to Dan Now's initial picks from the beginning of the year. Amazon, it went down like a lot recently, but it's still up 16%. Meta is a huge winner this year, up 52%. And they're probably going to be um, benefiting from the ad spend for the election in a couple months. In the next couple months, we have Texas Instruments up 15%. XBI, the biotech ETF, is up 11%. KWeb hasn't performed very well. So Stan Nels has done really well so far this year. Okay, so these are the earnings that came out this week. We had earnings from Eli Lilly. That was probably the biggest um, story of the week. They did really good with their earnings, and we'll go over that later on. And Berkshire Hathaway came out with their earnings at the beginning of the week. They mentioned that they sold half of their Apple stake, which was the market kind of didn't know how to take that, and they sold off Apple. Um, but I'm that doesn't bother me as a long-term holder of Apple because um, it was becoming a huge position, and there could be a lot of reasons why Berkshire Hathaway sold off their Apple position. Novo Nordisk, that's a competitor of Eli Lilly for diabetes drugs and the weight loss drugs. And they didn't come up with that great of earnings. And Eli Lilly went down on Wednesday because of that. And now Eli Lilly reported better than expected earnings, and they're actually taking over as the lead seller of weight loss drugs from Novo Nordisk. So there's a huge competition between these two companies. And they're actually knocking off a lot of these other companies that have been going down recently, such as this um, Dexcom and this Dexcom right here, Dexcom. So, so anyway, that's it seems like Eli Lilly is going to, and they're increasing their estimates too, Eli Lilly. So that's really good. Let's look at the earnings for next week, this coming week. So I looked at all these. A lot of these are smaller companies. Some of the more important earnings reports are going to be Home Depot on Tuesday. That's kind of a understanding of how the housing market is going, how the consumers are spending, and because I guess housing is a good portion of what the economy, what the customer spends in the United States. So that'll give you a good understanding of how good the houses are, the housing market's doing. And then UBS, that's a good company that tells you about, that's a finance company. We have Cisco coming out. That used to be a huge bellwether, a really big stock that tells you a lot about the internet back then, but now it's still pretty important. Walmart will tell us on Thursday about the consumer, and I'm guessing that um, they're going to report that the consumer is trading down to the Walmart level from other companies. Maybe Target's not going to be doing so good because Walmart is probably the lowest cost place to buy everything. So they could be doing well in this environment. Applied Materials, that's a semiconductor. Um, they supply materials for semiconductor industries. So that could tell a lot about the demand for semiconductors, which is a big part of the AI trade. Okay, now let's look at some of the charts that I picked out as interesting. I like stocks that are oversold. Like Google is an example of an oversold stock. You can see that has a very defined trend line. Google is right at a moving average. It's 100-day moving average right here. It's at the bottom of its chart and it's oversold. And a big worry for Google is that um, it lost a certain government antitrust ruling. So what's going to happen because of that? We don't know. But they really didn't do anything to Microsoft when Microsoft lost the same antitrust ruling about Internet Explorer 20 years ago, 40 years ago. So it doesn't seem, I think that the worst case scenario for Google is they make people choose between what search engine they want on an Apple device. So if they do that, almost everyone's going to choose Google anyway, so they're not going to lose any market share. They actually did that in Europe in I think last year or the year before. They made Google unbundle and they made the European consumer choose between all the different search engines, but they still, even after that, they did not lose market share in Europe. So if they do something like that as a remedy in America, everyone's going to choose Google and they're still going to have 95% market share. So we'll see what happens there, but I'm not selling. They're still growing at like 13 or so percent a year. And they're at a pretty good buy range. So they're oversold, bottom of their channel, and they're still in an uptrend. And the earnings estimates are still 13% for the next couple of years. Let's look at AT&T. Because interest rates are starting to go down, starting in September, people are going to be gravitating towards the stocks that are yielding a lot. And right now, AT&T is one of those stocks that are yielding 7 or 8%. And they're going to be in high demand. And we also have Philip Morris with a similar situation. They're yielding 8%. And you know how hard it's going to be in a year to get something that yields 8% or close to it. Um, because the Fed's going to start reducing interest rates, maybe 1 or 2% in the next year. So that's why people Altria has been flat sideways for like 2 years. And all of a sudden there's interest because of, the interest rates going down. Okay, and you can see from Meta, it's one of the stocks that's still in an uptrend, and it's up 52% this year, which is pretty amazing. And this is one of the strongest stocks charts that we're following. And it's not oversold right now. It's like halfway between overbought and oversold. Same thing with this chart. So let's look at Microsoft. Microsoft similarly is oversold. Its stochastics are way down to 19. It's oversold. And we also have the S&P down, oversold also. So this is an example of a stock that's um, it's overvalued right now, but it's still in an uptrend and it still has a lot of headwinds for it. It's growing its cloud by 30% a year, and it's very diversified. It has a lot of different ways to make money, um, and a lot of residual income. That means companies pay it a certain amount per month, um, regardless of the economy. And they have AI that might help all their businesses. We'll see. All right, so NVIDIA, this is one of the best looking charts that I've seen in a while. We have the earnings coming out in 2 weeks, and they're at the bottom of their range of their channel, up their black line channel, and they're super oversold. Um, so th if you haven't bought NVIDIA and you've been thinking about it, this is probably a good time. Um, of course, if they miss the earnings on um, the 28th of this month, then the stock will probably go down to here, which is their 200-day moving average, or maybe here, which is the 100-day moving average. So we don't know. We'll see. We'll watch for that. Eli Lilly, it was at the bottom of its range on Thursday, um, of its trading range. It was oversold. This whole downtrend for Eli Lilly was due to fear that they would be losing market share to competitors. And now they went up like 10% in the last week. And because they had a good earnings report. So let me see. But they're trading very expensively right now. Okay, so here's a little news story about Eli Lilly. They had a blowout quarter on Thursday, and that should quiet investor concerns. So they're basically growing at 36% a year. Their EPS jumped 85% um, year over year, which is pretty good. Um, they also hiked their full year guidance. And so everyone is like trying to up their earnings target. So a lot of companies have targets for the stock for the next year. A lot of them have targets of $1,100, which is a lot more than where it's at right now. So they also have this other drug, Kinsuna, which is the Alzheimer's drug. We don't even see that in the estimates now. So if they have next time they report, they'll probably have something in their report about this Alzheimer's drug, which is kind of exciting. We don't even know how much it's going to be adding to their bottom line. Okay, let's look at Eli Lilly. You can see they doubled their earnings from last year. And they're expected to grow, you can see they're expected to grow around, let's say 27% for the next couple of years. So that's pretty interesting for a drug company. They have a 0.58%. That's less than 1% dividend, which isn't that great. Um, Let me see. So there are actually some tailwinds for the company. Tailwinds are things that help the company. That drug that they're selling for diabetes and for weight loss, they're repurposing it for multiple diseases like heart disease. And so over time, that drug might be like a wonder drug that fixes a lot of problems. And that could help the stock a lot. Um, and the Alzheimer's drug, we don't even know what that's going to be doing. The other headwinds, competition, could be coming 2 or 3 years from now. But the great thing about Eli Lilly and Novo Nordisk is they're the first movers, and they have a lot of momentum. And it's really hard as competitors to 2 or 3 years from now to get into this market once they have the brand name. Eli Lilly, their PE is pretty high at 65. Um, Yahoo Finance says their PEG ratio is 1.45. That means Yahoo thinks that they're growing at 30+%. Um, you see, but their profitability is really good. The return on equity is 59. That's greater than 13 we want. And profit margin is 18. That's better than the 13 we're looking for. So the great thing about drug companies is you spend a large amount of money developing drugs, but once you've developed them, then it's basically gravy for the company, and they just make this return on equity, and the profit margin goes up exponentially if they have a drug that's really good, because you get to charge you know, a lot of money for the drug for the next 20 years without incurring much costs for manufacturing. Okay, so this is the story of the week was the stock market was going up and down like crazy. It went down 10% at one point on Monday, and it went back up. And um, then we had a rally on Thursday to the best day gain since 2022. Um, so, and there was a volatility strike, a spike up to 40%, 40 on the VIX. So there's been, like I mentioned last week, there's been a flip in how the 10-year is perceived. And it seems like this article here that it was in Yahoo Finance also mentioned the same thing. The bond and stock correlation flips. That flipped last week when we mentioned that. So the old narrative for interest rates, we wanted it to go down because that kind of means that um, the Fed would be forced to reduce interest rates. But now we want the interest rates to go up because that means that the economy is doing good and we won't go into a recession. If we go into a recession, that means the stock market goes down 15%. And that's the way that is. This is an interesting cartoon. Josh, Joshua Brown posted on Twitter. And in the summer of 24, I liquidated my entire my retirement portfolio because of something with the Japanese yen being carried. So that's an example. You know, if you were on Monday, if you saw all this volatility in the stock market going down 5%, 10%, um, but you didn't understand why, you might be telling your grandkids that. And the reality is you have to look at it and understand how that affects your portfolio. For something in the Japanese market, how does that affect the people buying weight loss drugs in America? It doesn't. And the same thing with Microsoft. How does it affect the number of people renewing their Office 365 subscription? So you just have to take a step back and understand that sell-offs usually are accompanied by the stock market going up again right after a sell-off. Um, okay, so that was funny. Okay, so I mentioned this has been in my notes for these meetings for a long time now. I'm just reviewing this now. Um, the playbook for surviving market crashes. So if you have a market crash, you have to you have to figure, is it going to affect my position 1 year or 10 years from now? And if you don't understand why the stock market's going down, then you certainly can't decide whether you want to sell your stocks or not. Um, okay, so quality stocks and indexes will trade down to a peg ratio of 1 or lower. So if we look at this, okay, this is the screen I just did for quality companies that pass all of my um, things that I want for a stock. You could see the peg ratio on the screen. Most of the high quality stocks have a peg ratio of greater than 1 because you pay more for a car that starts in the morning. A lot of times when the stock market goes down, the stocks go down to a peg ratio of 1. So in case of Google, it'll go down 15% because it's a peg ratio of 1.15. And MasterCard will basically go down in half, and then it'll be a peg ratio of 1, for instance. So, but a lot of times it bounces whenever, let's say that's growth rate. So now let's look at, so that's what that means. When there are crashes of 10 or 20% in a short amount of time, there's usually a recovery of 10 to 20% within a few months. So that's what I've been saying for a while now. But in this circumstances, we did have a crash of 10% on Monday for a lot of stocks, but they did recover within a week actually this time. So, but if you decide to sell during a sell-off, um, you have to make 3 decisions right. When to sell, when do you want to get back in, and what do you replace your investment with when you want to try to get back in? And it has to be better than what you sold. So there's a 3 basically very hard decisions to make. It's easier just to hold and not sell. But if you do sell and you've had gains, you got to pay 20% of your total gains to the government. That's capital gains tax. And that's not in your best interest. Let me see. So, so a lot of times it's better just to buy and hold and make sure you don't borrow money and do anything crazy with options. Then you should be okay. All right. So I did this stock screen on Fidelity. Um, my my criteria for buying stocks are, let's look at it right here. Okay, return on equity, profit margin, market cap, forward PE, growth rate, and PEG ratio. These are all the important things that I see in a growth stock. We want companies that have a high free cash flow. The PEG ratio should be less than 1, or pay a little bit more if it's a quality company. Return on equity greater than 10. Company has a competitive edge, dividend, little to no debt. So we did that screen. Let's look at our screen results. Let's see. Okay, so I got some MasterCard is always at the top of these. You know, they have a huge cash flow, return on equity. They're not doing so good this year. But they're still trading a little bit really at a premium, right? 1.82 peg ratio. I highlighted ones that are pretty interesting. We have PDD Holdings, they're a Chinese company. 0.42 peg ratio. Because it's Chinese, I'm staying away from it because we don't understand what they do over there. And Progressive, that's an interesting stock. Their peg ratio is 0.4, they're half price, according to this screen. They're growing around 30% a year, according to this. That is pretty amazing for an insurance company. And Progressive has that bonus of all the insurance companies are raising their their rates like 20% a year. I mean, it's just outrageous. And they're getting away with it. So I thought it'd be interesting to look at that one. American Tower, they're actually a company that's a REIT. They do cell towers. They rent cell towers to major, so they might have a tower that they rent to T-Mobile, AT&T, and T, and Verizon. But because of they're a land base, they're a REIT, so they pay a large dividend. But so that's an interesting stock. Their PEG ratio is 1.27, which is pretty expensive, but they do pay a high dividend, which might be interesting to people now that interest rates are going down. Okay, we have this Airbnb, which is very interesting. It's 15% discount, according to this. 0.87 PEG ratio, 0.84 PEG ratio. So they're growing. This is amazing. Their return on equity is 58%. Their cash flow is 55% growth. And the revenue growth is 22%. So they're growing at least 20%. And they're 15% off. They did have a bad earnings report saying that people, their customers are kind of cautious now, which kind of scared some people. But just think of that business model for Airbnb. They have zero um, houses. They don't have any inventory. They don't have any houses. They just have a computer server basically telling people where they can go to rent someone's house. And they have liabilities where if someone, you know, hurts a house while they rent it, they have to cover that or something. But for the most part, their costs are servers and the people on the phone that help um, the customer operators and things like that. So I think that's a pretty good business model and something I'd be interested in. But right now you have the possibility of a slowing economy, which people might not go on as many vacations. Um, if I was, I didn't have time to look at this right now, but it seems like it's 15% off. We have Apollo Global Management. I don't know anything about that company. They are 23% off, it seems. They're growing at hmm, looks like around 40% a year. Um, but I don't know anything about Apollo. Um, Royal Caribbean, I know they have a lot of debt. They do the cruise lines. They seem like they're half off. The PEG ratio is 0.55, and they have a lot of good numbers. I have I've colored I've color coded the best numbers in the group by green. So the top 15% of stocks I color coded green. Then the next 20% I highlighted yellow. That's why I like to bundle a lot of the green and yellow, and that tells me that that could be a good stock to look at. Um, Super Micro is the other one that's on this list near the bottom here, but its PEG ratio is 0.41. That means it's half off. They seem to be growing like 20%, and their long-term growth is like 50%, which is pretty decent. So we'll look at that one and we'll look at Progressive just for kicks. Okay, Progressive. This is the auto insurance company. I'm sure they do other kind of insurance, but they're famous for their auto insurance commercials. Okay, so the interesting thing about this is they doubled their earnings from last year to this year. I don't know how they did that. I couldn't find anything on it. But from this year to next year, they're only growing at 3%. Um, I couldn't figure that out why that happened, but um, it's really hard to value a company that's inconsistent like that. Why would they be growing at double from last year to this year and then 3% from this year to next year? And there's no earnings estimates going forward. So doesn't have a lot of coverage, this stock. So I guess I got to research it more to really figure out why the stock is so inconsistent. But they do have a tailwind of insurance going up 20% and no one's saying anything, and they can charge what they want to charge, it seems. Um, okay, so this is a news story. The Progressive Corporation just beat earnings expectations. They, it seems like revenue. Okay, so they beat their earnings revenue estimates by 2.5%, and their earnings per share came up 40% ahead of expectations. So I guess that was recent. That was August 8th, Thursday. Um, so it's really hard. It's really hard for me to value this company. Their PEG ratio is just around 1. Um, their forward PE is 20, and their return on equity is really good, and the profit margin is good too. So this looks like a good company that I would look into, but I don't know a whole lot about the insurance business in general. But this company, Progressive, is basically 100 years old. It is a really old company. For it to be, it, it's hard for me to get my head around this one. So we'll have to come back to it after I figure out why it could be so inconsistent with its earnings. All right, let's look at Super Micro as the next one. We looked at this before. It's basically down over 50% from its high a month or two ago. So the stock is obviously, look at this right here. This is the stock chart. It's down 50%. This is the long-term growth chart right here, basically. All these rectangles going up. So it seems, okay, there's not that many estimates, that not too many analysts covering the stock. So we don't have a whole lot to go on. We have from last year to this year, it's up 36%. No, from this year to the next year, it's up 36%. Then the next year after that, it's growing at 22%. So let's say it's growing at 30%. The PE is only 25, so the PEG ratio is 0.8. That means it's 20% undervalued. So the tailwinds for this company, there's AI data center build out. So as NVIDIA grows, as the AI data centers are built by Microsoft, Google, and Amazon, um, we also have the systems being built by this company. So there's a stock split coming up 10 for 1. That's a bonus for the company. And they were just recently added to the S&P 500. And that gives you a certain amount of credence. And because to be included in the S&P 500, you got to be pretty good company to be added, because the S&P company only adds companies that are quality companies that they want to help their index. Bad things about headwinds. Possible headwinds are competition from Dell. Maybe AI won't, the companies won't make money from AI, and then they'll stop spending. And then all this will crash to the ground. We don't know, but that was interesting to go over that. Um, all right. Well, let me see. Okay, that's pretty much what I had to say for today. I hope you had a good time listening to this, and I'll see you all next time.